While most people were distracted by headlines about inflation prints, election cycles, and daily market swings, something far more structural shifted in the background. The world's most important resource began to disappear from circulation, not vanish in a physical sense, but retreat. The resource is not oil, copper, lithium, or even gold. It is dollar liquidity itself, short-term, usable settlement-grade money, and it is being hoarded. In one sentence, here's the core event. Global institutions are pulling liquid dollars out of circulation faster than the system can replace them. This is not a theory. It shows up in repo volumes, in cross-currency basis swaps, in reserve balances, in commercial bank lending growth, and in how quickly money now sticks inside balance sheets instead of flowing through them. Since 2022, the Federal Reserve has reduced its balance sheet by roughly $1.3 trillion. At the same time, U.S. Treasury issuance has surged, over $2.5 trillion in net new supply across 2023-2024. That combination forces private institutions to absorb more government debt while operating with fewer system-wide reserves. In other words, more obligations, less grease. Why is the crowd missing it? Because the surface indicators still look fine. Equity indices make new highs. Unemployment remains historically low. GDP prints positive. But those are lagging outcomes. Liquidity stress shows up first in plumbing, funding markets, bank behavior, collateral preference, and who is willing to lend overnight. It is boring. It doesn't trend on social media, and yet it is where every modern crisis begins. The forcing mechanism is mechanical, not emotional. Higher policy rates mean idle cash now earns 5% plus in risk-free instruments. That changes behavior. Banks, funds, and corporations no longer feel pressure to deploy capital quickly. They can sit, they can wait, they can roll shorter. At the same time, regulatory frameworks after 2008, liquidity coverage ratios, stress tests, capital buffers, reward institutions for holding the safest, most liquid assets and penalize them for extending balance sheets. The rational response is hoarding. Every actor is incentivized to become conservative at the same time. A multinational firm holds more cash just in case. A bank tightens credit standards by a few basis points. A fund rolls into treasury bills instead of corporate paper. A market maker widens spreads to protect inventory. Individually, these are prudent decisions. System-wide, they drain velocity from money. The same dollar circulates fewer times per year. If velocity falls from 5 to 4 in a $25 trillion economy, that is the equivalent of removing $5 trillion in transactional capacity. No headline will announce it, but supply chains feel it. Housing feels it. Small businesses feel it. Emerging markets feel it first. What's at stake is not just asset prices. It is the transmission of economic activity itself. When liquidity is hoarded, refinancing windows shrink. Inventory buffers thin. Trade slows. Volatility rises. Recessions stop being demand-driven and start becoming funding-driven. This content is for educational purposes only. It is not financial advice. Markets involve risk, uncertainty, and complex dynamics. You should consult qualified professionals before making financial decisions. Now here's where it gets uncomfortable. Hoarding is not a temporary mood. It is a rational response to the current structure. And once it begins, it creates feedback loops that make it self-reinforcing. Because the scarcest resource in modern finance is no longer oil. It is permission to use money. To understand why liquidity is being hoarded, you have to stop thinking of money as cash in a wallet and start thinking of it as capacity to settle obligations. In modern finance, almost no transaction is paid with physical currency. Everything is mediated through balance sheets, banks, clearinghouses, dealers, custodians. What matters is not how many dollars exist in theory, but how many are available for use right now. The system runs on layers. At the base are central bank reserves, electronic dollars that only banks can hold. Above that sit treasury bills, repo collateral, and money market funds. Above that sit bank deposits, credit lines, and commercial paper. Every layer depends on confidence that the layer below will remain liquid. When the Federal Reserve raises rates from near zero to over 5% in less than 2 years, two mechanical shifts occur. Holding cash becomes profitable. Extending balance sheets becomes expensive. A bank that once earned 0.25% on idle reserves now earns 5.4% risk-free. Lending that same dollar to a small business might yield 7 to 8%, but with capital charges, default risk, and regulatory scrutiny, the spread is no longer compelling. The rational choice is to sit on liquidity. At the same time, higher rates reprice every asset. A 10-year treasury at 1.5% in 2021 becomes 4.5% in 2024. That move creates mark-to-market losses across portfolios. Banks, pensions, insurers, and funds suddenly carry latent balance sheet stress. Even if those losses are unrealized, they change behavior. Institutions become defensive. They shorten duration. They reduce exposure. They keep buffers. This is where hoarding begins. Now add the Treasury's financing needs. With annual deficits running between $1.5 and $2 trillion, the government must issue enormous volumes of bills and bonds. In 2023 alone, gross issuance exceeded $20 trillion when rollovers are included. Someone has to buy that paper. If the central bank is shrinking its balance sheet, the private sector must absorb it. Who absorbs it? Banks. Money market funds, foreign reserve managers, pension funds, all of them must allocate existing liquidity to government paper. That money is no longer circulating through credit channels. Think of it like this. A bank holds $100 in reserves. It buys $100 in treasury bills. That $100 now earns yield, but it no longer backs new loans. Repeat that across thousands of institutions, and the system's free float of usable money shrinks. Funding markets reveal this tension. In the repo market, where institutions borrow overnight using treasuries as collateral, rates spike whenever collateral becomes scarce or balance sheets fill. In 2019, repo rates briefly jumped to 10% because banks were unwilling to deploy reserves. The Fed had to intervene. That episode occurred with far lower deficits and lower rates than today. Cross-currency basis swaps show the same story globally. When Japanese or European banks need dollars, they pay a premium to swap local currency for USD. That premium widens when dollars are scarce. Since 2022, those bases have repeatedly moved against non-dollar institutions, signaling global dollar tightness even while U.S. equity markets rally. This is the part most people miss. Liquidity is path-dependent. Once institutions restructure around scarcity, they build systems that assume it persists. Risk committees harden, models change, lending standards reset. Treasury desks prioritize optionality over throughput. Hoarding is not emotional. It is encoded into incentives. And because every major actor sees the same signals, rate volatility, deficit scale, geopolitical risk, they all respond in the same direction. Up the stack, this manifests as slower credit growth. U.S. commercial bank lending growth fell from over 12% year-on-year in 2022 to near zero by late 2024. In some categories, commercial real estate, small business loans, it turned negative. That is not a collapse. It is a withdrawal of velocity. A system can survive high debt. It can survive high rates. What it cannot survive is high debt and falling velocity. Liquidity hoarding is how that condition emerges quietly. And once it does, someone always finds themselves on the wrong side of the door when it closes. Liquidity hoarding is invisible until it collides with obligation. The system only reveals stress when someone must act and cannot. That is when pressure concentrates, and in every tightening cycle, the same groups end up trapped, not because they are reckless, but because their business models require continuous access to funding. The first group is borrowers who depend on rolling short-term debt. Commercial real estate is the cleanest example. In the U.S. alone, roughly 1.6 or 1.8 trillion in commercial mortgages mature between 2024 and 2027. Most of that debt was underwritten when rates were between 2% and 4%. Refinancing at 6 to 8% changes the math completely. A property yielding 5% cannot service an 8% loan without injecting new equity. Either the borrower brings cash, the lender extends terms, or the asset changes hands. But lenders are now hoarders. Banks face regulatory capital charges on new loans. They face exam scrutiny on legacy portfolios. They face unrealized losses on existing bond holdings. Their rational response is to not grow balance sheets. So when a borrower shows up with a maturing loan, the bank's binary choice becomes refinance and increase exposure at worse terms, or force a paydown, sale, or default. Multiply that across thousands of properties, and the market becomes illiquid, not because buildings vanish, but because credit does. The second group is leveraged financial actors. Hedge funds, commodity traders, market-making firms, and risk-parity strategies all depend on cheap, reliable funding. They operate with leverage ratios that assume overnight markets will function smoothly. When liquidity is hoarded, haircuts rise, margins increase, funding tenors shorten. A fund running a 5.1 leverage ratio can survive a 1% adverse move. It cannot survive a sudden demand to post 20% more collateral across positions. That is how orderly markets become disorderly. Positions are not closed because they are wrong. They are closed because they are illiquid. This is the binary framing. Either funding remains abundant or forced sellers appear. There is no middle state. The third group is governments outside the dollar core. Emerging markets fund trade, energy imports, and sovereign debt in dollars. When global dollar liquidity tightens, their currencies weaken. A 10% depreciation raises the local currency cost of servicing dollar debt by 10%. For a country with $200 billion in external obligations, that is a $20 billion shock without a single bond maturing. They face a cruel choice: defend the currency by raising rates and draining domestic liquidity, or let the currency slide and import inflation. Either path slows growth, either path feeds political instability. This is why dollar scarcity propagates outward. It is not ideological, it is arithmetic. We have seen this movie before. In 1997, Asian economies with dollar-linked systems faced sudden capital withdrawal. Funding dried up, currencies collapsed, output fell 5–10% in a year. In 2008, US and European banks lost access to wholesale funding. Interbank markets froze. Central banks became lenders of last resort at massive scale. What is similar today is the structure: high leverage, maturity mismatch, reliance on continuous rollover. What is different is the backdrop. In 2008, policy rates fell from 5% to 0 in months. Balance sheets expanded. Today, inflation constraints limit that response. With CPI still oscillating between 3 to 4%, central banks cannot reflexively flood the system without risking credibility. So the actors who are trapped are those whose models assume elastic liquidity: property owners with floating rate debt, small and mid-sized banks with concentrated loan books, leveraged funds in rates, commodities, and volatility import-dependent economies, firms with thin cash buffers and heavy refinancing needs. They are not failing yet. They are waiting. And waiting is dangerous in a hoarding regime because every delay increases concentration. Fewer lenders, shorter tenors, higher margins, narrower windows. This is the part most people miss. Crises do not begin with collapse, they begin with refusal. A bank says not at that price, a dealer says not in that size, a fund says not today. Liquidity does not disappear, it withholds itself. The reason liquidity hoarding matters is not philosophical, it is mathematical. Modern economies are balance sheet systems. Every dollar of activity requires a dollar of capacity somewhere to intermediate it. When that capacity is withdrawn, growth does not slow smoothly, it gaps. Start with the basic frame. The US economy is roughly $27 trillion in nominal GDP. To sustain that level of activity, money must circulate. If each dollar turns over 5 times per year, the system effectively supports $135 trillion in transactional volume. If turnover falls to 4, capacity drops to $108 trillion. That single turn of velocity is a $27 trillion contraction in economic throughput. Nothing breaks immediately, but every marginal borrower, shipper, and employer feels friction. Now layer in the balance sheets. Since mid-2022, the Federal Reserve has reduced its assets by approximately $1.3 trillion. Bank reserves, system-level settlement capacity, have declined in parallel. Over the same window, the U.S. Treasury increased net issuance by roughly $2 to $3 trillion per year. Those bonds must be absorbed by the private sector. Every dollar used to buy a treasury is a dollar not available to back a loan, underwrite inventory, or finance trade. This creates a wedge. Public sector demand for funding rises, central bank support for balance sheets falls, private intermediaries must fill the gap using their own capacity. But private intermediaries operate under regulatory and risk constraints. A bank does not treat a treasury purchase and a business loan as equivalent. The treasury consumes balance sheet space, the loan consumes balance sheet space and capital. In a hoarding regime, the cheaper option wins. We can express this through 3 simplified scenarios. Scenario A, soft hoarding, base case, assume velocity declines modestly, say 5–10%. In a $27 trillion economy, that is a $2.7 trillion effective contraction in transactional capacity. Credit growth slows from 5% to 1 to 2%. Defaults remain contained. Growth persists but becomes fragile. Every shock, energy, geopolitics, weather, propagates further because buffers are thin. Scenario B, structural squeeze, stress case. Velocity falls 15–20%. That removes $4–5 trillion in effective capacity. Banks tighten. Commercial lending turns negative. Refinancing windows close. Asset prices remain elevated for a time, but activity contracts. Inventory cycles shorten. Employment lags, then follows. This is where surprises appear: a regional bank, a property sector, a foreign sovereign. Scenario C, policy reversal, relief case. Velocity stabilizes because either deficits shrink materially or central banks re-expand balance sheets. Reserves rise. Term funding becomes abundant. Hoarding incentives weaken. This does not require zero rates, only credible elasticity. Without that signal, actors continue to defend. The data already leans toward A, drifting into B. U.S. commercial bank loan growth moved from +12% in early 2022 to near zero by late 2024. In real terms, adjusted for inflation, it is negative. Small business lending surveys show tightening standards at levels historically associated with recessions. Money supply measures, M2, contracted in 2023, the first sustained decline in decades. Repo markets exhibit periodic spikes. Cross-currency dollar funding remains persistently tight for non-U.S. institutions. Meanwhile, public sector absorption continues. If deficits remain near $1.5 to $2.0 trillion annually, and the Fed continues quantitative tightening at even $500 billion per year, the private sector must absorb $2 to $2.5 trillion in net paper without a matching increase in reserves. That is pure balance sheet compression. The system can do this for a while by repricing risk. Spreads widen. Tenors shorten. Equity multiples float above slowing cash flows. But repricing is not the same as expansion. It redistributes scarcity. It does not remove it. This is why normal expectations fail. Traditional models assume that higher yields attract capital and restore equilibrium. In a hoarding regime, higher yields attract defensive capital. Money flows into instruments that do not circulate. Treasury bills, reverse repo facilities, and reserve balances expand, while credit channels stagnate. The economy does not run on money. It runs on permission to use it, and the data shows that permission is becoming conditional. When liquidity is hoarded, markets do not fail in a straight line. They fracture. Price discovery becomes uneven. Correlations that held for years break without warning. What looks irrational on the surface is usually a mechanical response to balance sheet stress underneath. The first transmission channel is spread behavior. In healthy conditions, risk is priced continuously. Credit spreads move a few basis points at a time. Bid-ask ranges stay tight. When liquidity retreats, those cushions vanish. Dealers widen quotes, not because fundamentals changed overnight, but because they are protecting inventory. A corporate bond that traded at Treasury plus 140 basis points might suddenly clear only at 190. Nothing happened to the issuer. What changed is the dealer's willingness to warehouse risk. That is the signature of hoarding, price moves that reflect capacity, not information. The second channel is volatility compression followed by air pockets. In a hoarding regime, fewer participants are willing to take the other side. Markets appear calm until they are not. Volatility indices remain subdued while positioning becomes brittle. Then a modest shock, a CPI miss, a funding spike, a geopolitical headline, forces de-risking. Because depth is thin, small flows create large moves. Gaps appear, stops cascade. Observers call it overreaction. Structurally, it is under liquidity. The third channel is forced liquidation. Leverage depends on stable funding. When haircuts rise or margin terms change, positions must be reduced regardless of conviction. This is how shocks propagate across unrelated assets. A rates fund hit by a repo squeeze sells equities. A commodity trader posts margin by selling FX. A risk parity strategy cuts exposure across the board because realized volatility rose. Nothing is wrong with those assets. They are simply collateral. This is why hoarding regimes create strange price behavior. Equities rally while credit weakens. Government bonds rise even as deficits explode. Real assets lag despite inflation narratives. Emerging markets underperform even with strong trade balances. The system is not expressing belief. It is expressing constraint. Feedback loops then reinforce the behavior. As volatility rises, risk models demand lower exposure. As exposure falls, market depth thins further. As depth thins, each trade moves price more. That increases volatility again. The loop is mechanical. Observers often misread this phase as manipulation or panic. In reality, it is plumbing. What should be watched is not headlines, but stress gauges. Funding spreads in repo and commercial paper cross-currency basis, for dollar funding credit default swap indices, especially financials. Inventory levels in key commodities, ETF, premium, discount behavior. The shape of the yield curve at the front end, bank lending surveys and deposit flows. These are early warning systems. They show when hoarding crosses from preference into necessity. In 2007, equity markets peaked in October, while interbank funding markets had already seized in August. In 2019, repo stress appeared months before the pandemic shock. In March 2020, Treasury market dysfunction, not equity selling, forced central bank intervention. Crises begin where balance sheets meet obligations. The reason reactions feel irrational is that observers focus on narratives while markets respond to margin. When liquidity is abundant, stories drive price. When liquidity is scarce, terms drive price. This is why bad news sometimes rallies markets, because it implies policy relief, and good news sells off, because it threatens tighter conditions. The market is not voting on growth, it is negotiating survival. Hoarding turns markets from opinion engines into clearance mechanisms. Every move answers one question: who must act now? Hoarding regimes do not resolve through narrative. They resolve through constraint. Either capacity is restored or the weakest link is forced to clear. What makes this phase dangerous is not that something will break, but that no one can predict which node absorbs the shock first. The timeline matters. Next 24-72 hours, markets remain headline-driven. Price action looks disconnected. Volatility compresses. Liquidity appears fine on screens. Stress shows up only in plumbing, overnight rates, collateral availability, and dealer behavior. Most participants feel no urgency. Next 1 or 2 weeks, positioning becomes brittle. Any surprise, economic data, geopolitical escalation, policy language creates outsized moves. You may see rallies on bad news and sell-offs on good news. That inversion is a signal that markets are trading policy probability, not fundamentals. Next 1 to 3 months, balance sheet pressure surfaces, refinancing windows narrow. A sector shows strain: regional banks, commercial property, a foreign currency complex, a commodity market with delivery stress. It will not look systemic at first. It never does. Next quarter, either capacity expands or a clearing event forces it. Central banks respond after plumbing shows strain, not before. The timeline is always reactive. From here, 3 scenarios dominate. 1. Base case: managed friction. Liquidity remains tight but functional. Velocity drifts lower by a few percent. Growth slows but avoids collapse. Policymakers talk dovish, act cautiously. Markets remain range-bound with episodic spikes. Indicators: bank lending growth stabilizes near zero. Credit spreads widen modestly, 20-40 BPS. Repo markets remain orderly. Equity, volatility, oscillates without trend. Yield curve remains flat but not inverted sharply. This is the grind outcome. It feels frustrating. Nothing resolves. Everything feels late. 2. Stress case: balance sheet break. A node fails, a funding market, a property segment, a sovereign FX complex, or a leverage strategy. Liquidity gaps, volatility jumps, policy response follows, not precedes. Indicators: sudden spike in funding spreads, cross-currency dollar basis widens sharply. Credit default swaps on financials, jump ETF premiums, discounts diverge, forced selling across unrelated assets. This does not require a recession headline. It requires one actor who cannot roll. 3. Relief case: capacity expansion. Policy shifts restore elasticity. Central banks halt tightening, expand balance sheets, or provide targeted facilities. Fiscal authorities reduce issuance pressure. Hoarding incentives weaken. Indicators: reserves rise. Funding spreads compress, term lending expands. Credit growth turns positive. Volatility declines structurally. This is not bullish. It is stabilizing. It replaces defense with throughput. The core takeaway is structural. Markets are not primarily reacting to beliefs about the future. They are reacting to permission to operate in the present. Every modern crisis has begun when that permission became conditional. In 2008, it was interbank trust. In 2020, it was treasury market functioning. Today, it is balance sheet willingness in a high-rate, high-deficit world. Hoarding is not fear. It is adaptation. And adaptation reshapes the economy long before it reshapes headlines. This material is for educational purposes only. It is not financial advice. All markets involve risk and uncertainty. Consult qualified professionals before making decisions. If you want continued updates as this structure evolves, subscribe and stay with the series. The goal is not prediction. It is understanding the machinery before it moves.